I will run through my presentation whose topic is why the resource junior hesitancy. We went through a 10-year bear market that started in 2011, and last year, after the initial wallop in March, we had a tremendous awakening that carried on right into this year until about the second quarter. But since then, it seems like the audience for the resource juniors has evaporated. And I'm looking at the copper price, I'm looking at the gold price. What is wrong with these levels? Why has the audience vanished? We're dealing with a potential roaring 20s type pandemic recovery. We've got infrastructure renewal in the works, make America great again, repair all its failing infrastructure. And we've got infrastructure transformation also in the works, preparing for a clean energy future. And we have ESG as a factor that has never really been part of the whole junior resource game. And it's an important one because it gets rid of this idea that the biggest and best is all that mining will ever be about. And we also have this great power competition between China and the United States, which is not lessening at any point. So why this hesitancy? We look at the projections that the IMF has made for the global economy, and you can see the dip that we experienced last year as a result of the COVID response. But they're talking about the economy growing $28 trillion over the next 5 years. That's 30% growth. Now that means a lot more metal than what is currently being supplied. And here I've got sort of four charts showing the evolution of supply. Up here in the left corner, we have copper. And copper has actually been sort of flat going down for the last 5 years. It is both going to track the macroeconomic growth of the economy, plus there's going to be additional demand from the electric vehicle rollout as this keeps growing and growing. Nickel production has also been sort of flat with a big dip when Indonesia shut down. That's going to track the macroeconomy because we're never going to need to use stainless steel. And it may even be part of the electric vehicle future. Right now, there is an incredible battery innovation arms race underway. We do not know in 2030 what will be the battery that it becomes the winner take all, what its configuration will be. But nickel might be part of that future battery that becomes part of every future electric vehicle. And then we've got lithium, which had a tremendous growth spike 4 or 5 years ago. It's subsided in the past couple of years, but lithium is going to be part of the electric vehicle future. And then look at rare earths. It's still dominated by China. And while there has been new supply going forward, it's a serious geopolitical problem. And it is also part of the electrical vehicle rollout that's underway. So in all these areas, you can expect demand for raw materials to keep growing and growing. And the prices that we have now, they are all elevated from what they were a few years ago. And of course, the decade of bear market that we had was partly due to the oversupply that created during the China super cycle during the 2003 to 2010 period. But that has now been absorbed by the growing economy. So there is now plenty of room for prices to not just stay where they are, but go higher. So the ESG factor is a relatively new thing, and everybody's familiar with the environmental aspect, the emission controls. We want everything to not be polluting. The social, it's also local stakeholders, worker health and safety, and so on, and the push for less inequality. But though it's the G in for governance. That's become a very important deal for the juniors. Now, normally this deals with corporate transparency, but increasingly it is about the shock that has happened from the COVID pandemic to the global supply chains. And there was also with the emergence of the great competition between China and the United States, this idea of a globalized economy is not such a sure thing. And what the various shareholders of companies are starting to say, you know, you're doing everything in hyper efficient manner, just in time supply chains. But when there are disruptions that are unpredictable, such as the COVID pandemic or possible geopolitical conflict, you're screwed because you're depending on everything coming at the cheapest price from the best producer. So now we want you to reverse some of that efficiency and build in redundancy and resiliency. And also, by the way, we are concerned about the other issues, environmental and social. We don't want you to be using metals that come from the dirtiest, nastiest jurisdiction, because there's a new problem coming. Because with the media, the way the media has evolved and blockchain systems have evolved, the future will allow end users to be able to establish where their metals come from, and the public will ask to see the source certification, and they'll want to see it verified. So there is a potential public relations nightmare coming for big companies that do not consider the ESG nature of their raw inputs. And this is important for the resource juniors because, you know, the best jurisdictions are United States, Australia, Canada, a few other places. It's becoming more difficult in a lot of these other regions, these frontiers that exploded in the past 20 years. But these regions have already been picked through well. The deposits are harder to find, and they may not be as high grade as they are in some of these woollier jurisdictions. But there may be now a future for a discovery or an existing deposit that may not be as great as something in the Congo, but it still will be developed because it can deliver ESG credentials. And this old idea that the corporations have only one duty, and that is to the shareholders that Milton Friedman talked about, that's going out the window. So there should be a future for resource juniors finding stuff that doesn't have to be the absolute biggest and best discovery in the last 50 years. So speaking of great power competition, here we have the green is the global GDP and the projections by the IMF, and the blue is the percent that US GDP represents, and the pink is China. And you can see this convergence is continuing, and that is the foundation of this great power competition, because by 2030, these two economies will theoretically be equal sized. And in terms of the military, the United States is still way above the Chinese in military spending, but China clearly has ambitions to rival the United States. And the problem is the hope that we had 10, 15 years ago that China would become a democracy. Well, it is now clear that Xi Jinping is pushing for Mao Zedong 2.0, and this is a trend that is not going to go away. And it's not the old central command economy of traditional communism, which is always going to implode. It is more a government-controlled private sector. It's a different type of economy, but it is run by the Communist Party, and there is no other competition within China to run that country. So geopolitical tensions, the business with Taiwan and that's going to be a big problem. So it isn't just the building in resiliency for your supply chain, but there may be some substantial disruptions coming, which may prevent metals that either will get routed through China or originate China from being available to many other parts of the world. So that's all bullish for the main metals, but it's also bullish for gold, because gold is the ultimate uncertainty hedge. And, you know, back when the communism collapsed in 1991, Francis Fukuyama wrote a book about the end of history, everything's going to be great. Well, we've reached a point now where the history is wide open. Even within democracy, there's a push for autocracy, to have a Mussolini be in charge, to lick the boots of these masters, to be slaves. It's this insane craziness out there. And that really should be good for gold, because we have no idea what's going to happen down the road. Now, this graphic up here, I've used this many times in the past. It basically shows the price of gold, and it's overlaid on the GDP and the gold stock growth. And they're not really linked in any way, but what if you take it down here and take the value of the gold stock and take it as a percentage of the GDP in each year, and then just plot it? And what you'll see is that the value of gold tends to rise in periods of substantial turmoil. And we saw that in the late 70s. We saw it again after the financial crisis. And then we seemed to enter a period of calm, but COVID sent us to a new high. Gold actually managed to make it through $2,000, and it sort of settled back in a range where the gold stock, which is about 200,000 tons, it's somewhere between 12 and 14%. And if we take the extremes from the past of 1980 and in 2000, when it looked like the United States was the eternal winner of the whole global power game, and we convert this over here into percentages of future GDP, well, we can see gold dumping back down into $500, $600 range, or we can see it go up to as high as $4,000. So when people talk about gold potentially going to 2,000, 3,000, 3,000, 4,000, it doesn't have to be about inflation. It can be about stress in the global economy. And this year, what I've got pointing forward, sure, it says in 5-year gold is going to be $2,000. That's based on the idea that 12% is now the stress level that gold is going to maintain. But it is the idea that this $1,800 gold that we have now, never mind the $50 wobbles such as today, this is the new reality going forward. But the market doesn't seem to believe it. It seems to think that gold is going back to 1,300, that copper's going back to 250. And that is the key, is when does this market out there decide that the current prices are at a minimum the base for future higher prices? So this is the history of resource sector, TSX listed resource junior financing. Tremendous boom during that 2010 to 2011 period when gold almost hit 2,000. We had a bit of a burst in 2016 when we thought gold was rising again, but then we had this 5-year slump, and things took off in May of last year, and it was driven by gold. The market was addicted to the uptrend in gold. This portion of the financing activity was mainly gold related, and that subsided when gold pulled back. But then we had another tremendous boost in the early part of this year. And this was more than the non-gold related metals that caught the whole energy clean energy transformation and infrastructure renewal expectations with the Biden victory, the possibility that they might actually have fiscal stimulus. So in this just over 15-month period, 7.7 billion was raised by the TSX resource listings, compared to 7.4 billion during this 4-year period prior to May of 2020. And it is in much better shape. This used to be over 50% companies with negative working capital. Now we have over half the companies with more than $500,000 in the treasury. The resource juniors are in great shape, and yet they're behaving almost as if it was 2 years ago in 2019, early 2019, when this was over 50. It was almost 60% of companies in the money, and this was just a very small group, several hundred companies that had a meaningful amount of money to get something done. So this graphic here tracks the value traded relationship between TSX Venture resource and non-resource listings. And you can see that there was a tremendous boom back again when gold was running towards $2,000. And the split between resource and non-resource was pretty much even. But then as our bear market began, the non-resource listings became ascendant, and we had a small burst in 2016 again when gold rallied towards 2014 before falling back again. And then the themes of cannabis and blockchain, crypto, and all that came in and pretty much dominated this period. But when gold took off last year, we, again, the resource juniors were more than 50% of traded value. But again, as soon as gold reversed its uptrend, back down we went. And even though there was a big trading activity during the first quarter of this year, the non-resource listings dominated the scene in terms of trading activity. But now, curiously, we almost see maybe possibly a crossover happening that's come back from being low 30% to being almost 50%. So we'll see going forward if there is an inflection in the works. Now, here's part of the problem. This is where American households have their capital parked. And household deposits, that tends to be the 99 percenters. Stocks all gone up. Mutual funds, which are the same as stocks, but are separate. These are directly owned stocks. This shows that in the past year and a half, tremendous increase in net worth has taken place amongst the Americans. But at the same time, you see that T-bills and bonds have gone down, which makes sense because the pandemic response of buying $120 billion worth of T-bills and stuff has driven the price of them way up, which means the yields are way down. And everybody's pretty concerned that at some point, this has to reverse. But where is all this capital parked? Why is none of this really moving into the junior resource sector? Now, here we see how the inflation has had a significant bounce back. It's 5.3%, which is really kind of a catch up to what was happening before. It's a question whether this is transitory or part of the long-term future, whether it's going to be structural. But real rates at the moment are very negative. So there is reason to believe that yields will begin to rise, and people who have exposure to bonds, they're going to suffer principal loss. And so a lot of this money has been going on into stocks because there really is no alternative. And as long as it keeps going up, or at least stays where it is, everybody's reasonably happy. But the audiences that traditionally watch the resource juniors, they are nervous about that. And here's what I started doing last year when we had that March meltdown. I took the 20s period and the 10 years prior to that and normalized it all to 100. And I've been tracking it daily. And it had a very similar rebound, but it has bifurcated. Whereas in the 30s, everything after a short recovery just got worse, worse, and worse over the next several years, and then didn't do pretty much going forward. Here we are at almost like it's ready to tip back into the garbage can. And this is the nervousness happening in the market right now. Some of the hesitancy with regard to the resource juniors is that there is fear that there's going to be a crash, which makes everything come apart and drags down the global economy and makes those IMF predictions of $28 trillion growth over the next 5 years just pure fantasy. So here's the elephant in the room, though. These are the pension entitlements of American households. That's 30%. Between these three groups, net equity, pension entitlements, and stocks, that's over half of the net worth of US households. And these pensions are held by all these different pension plans. They can't afford for this stock market to go down. So maybe this big crash that we're expecting just won't happen. But another interesting thing is this is largely owned by the boomers, people who will be, all of whom will be 65 and over by the end of this decade. And there's this end-timer psychology in this boomer generation that seems to be not sharing the same sort of perspective as the younger generations, the Millennials, Generation Z. And what happened last year is a bit of a shakeup in the way things are going forward. There is a conflict coming between end-timers and the younger generation who want a future. And one of the difficulties with the traditional audiences for the resource juniors is there has not been any real replacement among the younger generations in terms of audience. And because every boomer is now 55 or older, the regulators are not very keen on seeing their clients that aren't the discount broker self-service type clients dabbling in the speculative junior resource sector. So this traditional audience is disappearing on us, and a younger audience is not coming in to replace them. And even worse, your typical person who used to be keen about the resource sector, they tended to be free market libertarians, that sort of right-wing type person. But something strange has happened in the last 4 years. They seem to have forgotten all this stuff about libertarianism and free markets, and they've become these insane autocrats supporting a failed president. And here we are coming out of this horrible period of lockdown and disruption of our freedom, deliberately rejecting the vaccine. And what is it but an act of economic sabotage that hopes to make the whole economy fail so that they can put their hero back in power? And this is creating a conflict too between the younger generations who really want us to get on from this COVID lockdown, masking and so on, and those who really don't seem to care about the future at all. And so what are young people doing? Well, maybe they're giving up. Maybe they are also becoming end timers. Momentum gambling is what they do. They believe the trend is your friend. Fundamental valuations are irrelevant. In this type of market like Tesla and cannabis and so on, every company is a potential winner that takes all. So they all can have insane valuations because you won't know who's a winner until the whole thing is over. And in this thing, it's okay to not know anything about these companies other than that it's going up and pumpers are talking it up. And really, there's this sense that time is on nobody's side. There is no time left, which is the whole psychology of the end timers. The time is running out. And that's why you have Bitcoin, which really serves no purpose at all, fascinating all these people just trading it, gambling in it. And it's just momentum gambling. It serves no purpose. Same thing with GameStop. It's just a social media short squeeze that was done, which simply hasn't gone away yet. So fundamental outcome gambling is what the resource juniors are all about. And that is what is part of the problem. The resource juniors, they're not very good for momentum gambling. In mining, there is no winner who takes all, but mining does create wealth. Now, any outcome in an exploration development play, it has a finite value grounded in physical reality, tonnage, grade, and cost. But it's not easy to quantify the size of the prize. Even some geologists don't understand the discounted cash flow model for valuing a deposit, a future mine. And of course, exploration, the outcome reveals itself over time. It takes time. You don't day trade these resource stocks except when there's some big pump going on and there's a war going on between the shorts and the bulls. And even worse, most people really don't know how to price the value of an uncertain outcome, such as the value of a coin toss. So we're losing the traditional boomer audience to simply momentum type gambling. People are used to love gold. Well, yeah, Bitcoin's the new gold, so we're going to gamble in that. And the younger audiences, well, the juniors are not really providing a gateway to allow them to find their way into this space so that they place longer term bets on fundamental outcomes that take time to unfold. And the key to all this is this simple equation where a coin toss, if you have a dollar coin and somebody says heads, if it comes up heads, you win. How much would you bet, put on the table win that coin toss? Well, the basic formula is that it's the future value multiplied by the certainty of that value becoming reality. And so it's quite simple. 50 cents is the value of participating in a coin toss, that placing a bet that heads will come up. If you're being asked to pay more than 50 cents, that's poor value. And if somebody's dumb enough to let you pay only 25% to bet on a dollar coin toss, well, that's good value. And in the resource sector, it's the same thing. And the key here is the staged exploration development cycle, which has very low certainties in the early stages that become much bigger certainties. And you can use these certainties to figure out what the current value for different prizes down the road will be. And this is, I put it all together. This is the basic formula that most people don't know, but it's the key to valuing a fundamental outcome. And I've put it together into a graphical form where this blue channel is actually this channel here. And because the market doesn't really behave rationally, I've also observed something called the S curve, which is especially during discovery delineation, where you don't know what the limit of the prize will be. You will often see the market pricing the company now at what it ends up being worth after $20–40 million have been spent and it's marched through this whole thing. And in fact, with the Arizona mining pick that I did in 2016, it worked perfectly according to this system. So the first company in my group is Sonoro Gold Corp. And its problem until yesterday was that it was developing a resource, but people did not understand the economics. They published a PEA. So what I've done is I've taken the numbers, put them into the discounted cash flow model, done a life of mine visualization, and you can see that now at the stage post PEA where they want to go into a permitting this thing, the fair value is 45 to 68 cents. But I've done something different. I've put in 75 million tons instead of the 32 million tons that they reported, and I ran it at the same grade. And that comes up with a bigger NPV than the company's nameplate PEA does. But also what this interests me about this company is if you run different prices, such as $2,300 or $3,000 gold, you can see much higher potential outcomes. So this company is one of my favorites because it can be, if gold just stays where it is, this stock could be a 90-cent target over the next 12 months from its current 22 cent level. But it can also serve as a proxy. If gold starts to run on the upside, this will be a go-to stock for the market. Now, Woodjam is in a kind of a similar situation, except they have not done a PEA yet. Over $30 million was spent delineating 3 deposits, one of which is the 227 million ton Southeast Zone deposit. It's basically a copper deposit, and the market has been treating it as if copper is still $250, and Gold Fields eventually gave it back to the company on fairly good terms because at $250, that asset is not worth anything. But what I've done is an outcome visualization where I got the numbers for what it would cost to build and operate a 30,000 ton per day open pit mine using the existing resource and likely recoveries and I've run it at $4.30 a pound, and I come up with a future price target of $3.56, and yet the stock is at 12 cents. The company at the moment is focused on expansion, but it has the potential to just go back if it can't find more, to just develop this. And this would be an example of what I was talking about earlier. It's in a region where there's infrastructure. It will be developed in a way that meets all the ESG requirements. And while it's not a world-class grade deposit, this could be part of what feeds the future, especially if end users become more concerned about diversity of supply rather than just-in-time supply from the biggest and best. The third company, Vanstar, is in a different situation. They have a carried to production deal with Gold, which has delivered a resource estimate for just about over 3 million ounces. It's an open pitable situation. And again, the problem the market has with this is, how do we price this? So I noticed that the Spring Pole project that First Mining Gold just did a PFS on is very similar to this. So I borrowed some of these numbers and modeled this and visualized what this would be worth. And again, we come up with a 345 target down the road if this thing gets to a production decision. And you can also see the optionality down here at $2,300 and $3,000 gold. Now the stock is cheap now because Gold controls the timeline. Gold is still doing expansion drilling. It has not yet shifted to economic studies, to a PEA, and we don't know when it will. So the market is punishing this company because it thinks the timeline is very, very long, and the company cannot control its destiny. The other two, Woodjam and the Sonoro, they control their timeline. So this is a case where you are paying on making a bet that the timeline will shorten considerably less than it was than the market's expecting. And then the final company in our group, well, I've imagined that they find a couple of deep post deposits at their Southgrass Valley project. I visualized what the outcome is. This is still target testing. They don't have a discovery yet. They have clues that a discovery might be made. But if they were to deliver something like 16 million tons of 20 gram per ton, well, that, if you do the math on a 3,500 ton per day underground mine, that's a $23 price tag. And here you can see the stock, it's actually below that channel. So in my view, if you believe that Southgrass Valley is the type of system that can deliver another North Carlin district, well, then you're talking very good speculative value. And of course, if they started delivering it, it wouldn't just hop into like this price range up here, 57 to $1.14. It would go into the S-curve territory. And that's why, in general, I am a fan of discovery exploration plays, because the market punishes them because of the low certainty that they'll actually deliver anything. But the instant they do, that's when all hell breaks loose. And that's also where you will see momentum gambling come into the juniors. It's generally not in the resource juniors, except when a metal is rising very rapidly for reasons that suggest it's sustainable. But it's in discovery exploration where you can get enormous changes overnight and the value potential of the company. That's where you can also get momentum gambling. But we can't wait for that. We have to teach the public, the younger audiences, how to think about these plays and adopt a patient strategy to be able to place the bet, put some work into understanding the play, monitor the data flow, and adjust positions accordingly, and always be on the lookout for other interesting opportunities in this junior resource sector. And that wraps up my session. It's 1-year memberships available for $450 until the end of the year. After that, I'm going to increase it substantially and change in how the whole Kaiser research platform works. It's going to become more of a research platform rather than a stock picking system.